प्रेजेंटेड बाय ईबिक्स कैश। हर खुशी के लिए काफी है।
Hello and welcome to this Business Today Market Special. I'm Udayan Mukherjee. With me is my co-host Abha Bakaya and a veteran of the stock market, Kenneth Andrade, who's the founder and chief investment officer of Old Bridge Capital. Kenneth has been in the stock market for several decades now, and he brings in that wealth of perspective with him. Kenneth, it's great to have you on the show today. When these days with such a powerful rally in the market, when we speak to market participants, we get one of two views. One, of course, is the skeptical one, which is that the market's headed for a deep correction very soon. And the other is that we are on the cusp of a really big profit upcycle after many, many years. And therefore, any correction will be just shallow. Which side do you veer to?
I think they are right on both contexts, and I just put it this way: there is a froth in a lot of businesses out there, and a lot of stocks that are trading out there. And if you just go by the year-ending numbers, which is basically 2021 March year-ending numbers, the profitability matrix has shifted to a very different kind of businesses that are there. So you got market capitalization sitting in one extreme of businesses, and in the other extreme, you got companies that are actually making cash flows. To put it simplistically, 2022 March end, if you look at what's going to contribute to profitability of the underlying indices, it's got everything to do with commodities, and they have no representation in the index itself. So I think that's the anomaly. Even if the market does correct itself, which we've seen multiple times before, that market's always correct. I think the leadership is going to be taken away from the businesses that have done well so far.
That's an interesting assertion. Are you saying that the expensive part of the market will actually lead the correction, and maybe other sectors will sort of balance it and become the leaders of the next upcycle, and that leadership will be in commodities? Is that what you're saying?
Yes, I'm saying exactly that, and there's a reason for it all also. And if you look at multiple trends and the multiple ways that investors flock around the besting in the marketplace, usually you try to justify valuations where they stand. Okay, and today it is price to sales. The world's are going to get digitized, and things are going to be very different after the next decade. But how much do you pay for growth? You go back to the 2007 and 2008 beginning rally of commodities and capex. You set up surplus capacities with that market capitalization there, and there you had you always argued for sum of parts and price earnings to growth. And then you go back to 2000 and it was valued very differently. So all bubble cycles take place. Whenever the bubble cycle takes place, you've got a very different approach to trying to justify valuations. And I think that's what's happening in the marketplace today. So whether it's 6 months, 1 year, I don't know how to time this, or we've never been able to time this very effectively. I think that part of the market is going to consolidate. You will have fewer winners come out from there, but the entire leadership is changing. Our sense is, yes, it's going to be manufacturing, which also includes commodities, and a whole host of other businesses where the visibility is fairly high. It's fairly high, and it's fairly high into the decade, not just the next year or two.
So, you've explained the principle or the philosophy behind your view, but for somebody who wants to take away something from an investing point of view, could you drill it down to sectors where you see the froth? Is it only because there are not too many digital stocks in the market? I mean, you can only name one Zomato, one Info Edge, etc. Are you also including the very highly priced consumer FMCG kind of companies which trade at 50, 60 P multiples? And when you say manufacturing, including commodities, are you talking about sectors like chemicals, steel, aluminum, maybe even some of the other exporting sectors? So what to buy and what to avoid? I mean, if you can drill it down to what you're saying in terms of sectors.
Simplistically put, our point of view is that whatever was done well in the last decade, and that was led by a consumer economy and a consumer rally, plus everything that leverages the consumer cycle, which is essentially the financials part of it, or the lending cycle of the financials part. I think that's going to get compressed in terms of valuations. Those businesses will still come out great at the end of in this next cycle, but you're not going to get a profit expansion or dramatic profit expansion, and that's not and that's also not going to create higher multiples than where they are right now. So that's the place that we're very cautious about. They will do well. Companies' profitability will grow, but I think they're already fairly well priced into it all. What's not really priced is the commodity cycle and manufacturing. So take India's largest steel company, right? Or even take India's largest aviation business. Now, those are companies and businesses that are throwing out enormous amount of cash flow. Or just look at utilities, what's happening out there. Those are the businesses that are throwing out enormous amount of cash flows, but you can actually value them based on our very traditional way of looking at cash flows. All you need is sustainability of that trend for not 10 years, but for the next 3 years. Okay, and if you get that sustainability for the next 3 years in terms of the cash flows that they're turning out, it is equivalent to their current enterprise value or to their current market capitalization. So what's happening with that, with companies that haven't attracted attention over the decade, is that no supply has come in. So it's been ignored not just by investors, it's also been ignored by entrepreneurs or private equity or the banking system. And that's created a supply crunch in the system, and demand still chugging along. So if you look at the supply demand economics, it's very much favorable to everything that we see doing well right now in terms of manufacturing, commoditized businesses, okay, some element of services businesses, real estate. Okay, I think we could be heading into a fairly long-winded cycle in a lot of these things, simply because we're not looking at 10-year visibility. Even 3-year visibility explains their current market capitalization.
Okay. So share with us, Kenneth, because you've talked a lot about how not to possibly expect expansion of PE multiples in certain pockets that are already fairly overvalued, given that easy money won't continue, relentlessly. Where would you say there is a case to find an opportunity to invest with a slightly longer term point of view, where you still see that opportunity, for stocks to grow potentially? Would it be in the mid caps? Would it be in the broader markets, even in preferred sectors, whether they be IT, pharma? Is that the way to look at it?
So over a longer term period, if you've noticed the current category leaders in the indices or the underlying indices, most of them were probably not present in the last decade. So over a long term, smaller companies do get large, both in profitability and both in terms of market capitalization. They just need a little bit of tailwind. They just need a little tailwind in their industry. So from a consumer cycle point of view, just look what happened. I mean, you've got a large NBFC and you got its holding company amongst the largest in the indices. They came from being mid-cap businesses. Okay, in the IT cycle, the IT pack were all mid-cap companies, and they became extremely large businesses, and now they are fairly dominant in the economic cycle also. What you're seeing now with chemicals is some of them are very large in terms of market capitalization. And what you will incrementally also see is some of the engineering businesses be up there. Utilities, which had absolutely no play in the entire market cycle or in terms of size, are now going to get that size out there. So that's the transition that we are seeing incrementally. So what's going to do well? We like companies and businesses that have now turned their focus into the export environment. That's where you address 100% of the world demand or 100% of the world GDP. Now what some of the Indian companies are doing, and most of these, and just take a simple industry like a metal forming industry, which has got to do with value-added steel, which is castings, forgings, automotive ancillary, etc. At present, and also going into the next year and a half, they will have a fairly large order intake. The reason why this is happening, or will happen also, is because the finished product that they do landed at the client's workshop, clients at its client's end is equivalent to the raw material in that particular country. Okay, so you've created what should I say, an industry with cost advantages till now, and now you've got the ability to sell it into the rest of the world and go out and get market share. So it's going to be more of a volume based approach to it all, like we did it with tech, like we did it with pharmaceuticals, like we're doing it with chemicals. Okay, we created an industry and now we're just going out and getting market share out there, and we've got the cost advantages. So there are a number of pockets like this that exist.
So,
but more prominently, they have to go and address the international marketplace.
right. So, speaking of international markets, Kenneth, if you have to play the export opportunity now, what's the better way to play it? I mean, is it through sticking to the traditional horses like IT and pharma, or to look at slightly newer rising sectors like chemicals, as specialty chemicals, as you mentioned, or even auto components? Where does the bigger juice lie in exports?
I think all of them will do well. Okay, the world's got to change its entire automotive fleet to electric. Okay, so obviously there's going to be some new component developers that are going to come through, and they're not going to come through from the traditional manufacturer, which is sitting out in China. So that's an opportunity that's opened up. The same thing with chemicals. Okay, everything that's going to go and get done is going to get done from India. So that's the transition that is taking place. And remember one thing, Udayan, the West has never invested in manufacturing capabilities. Okay, if you just take a simple industry like cement, right? India's largest participant, or India's largest player, it has a capacity of close to 140 million tons. Okay, the US consumes 90 million tons. Okay. The same thing holds good for steel. Now, if that economy goes into an expansion or goes into relocate the supply chains internally, there is, or even replaces power plants and replaces power plants with renewables, and that's what everyone's talking about, decarbonization, which will be a fact by the end of 2030. It is extremely material intensive, and you'll have to build capabilities to manufacture the materials internally. And to do that, you've got to kickstart the capex process within your country. So whether it is the US or whether it's some part of Europe, they're going to do that. And we've got, I mean, not just India, but the entire emerging market, which has taken over some components of what the Chinese actually did. All of them have the opportunity to fill the slot of the initial demand spurt that is coming through. And you're seeing that very clearly that's happening. India's doing it in chemicals, India's doing it in textiles. We haven't seen profitability in both those sectors as enormous as it's happening right now. Okay, I've never seen a textile company debt-free in my life cycle, and that's 30 years of even tracking that sector, and they become debt-free. That's how it's changing balance sheets. And I think this has a leg for the next 2, probably 3 years. And by that time, these companies will be enormously large, or some of them will be very large.
So let me ask you about another sector which you briefly touched upon, which is energy. I mean, you spoke about utilities, but I mean, looking at how this new electricity amendment bill has been proposed, if somebody were to look at energy as an investment opportunity, what would you recommend? I mean, to look at the traditional utilities which seem to be waking up from a stock perspective after many, many years. Should one look at an energy exchange, or should one look at some other cogs in the energy wheel? What would be the right way to approach it?
So it's going to be, so the way we play it, or we'll be participating with that is obviously one, the energy exchange, two, some capex which is driving that cycle. And when you talk about these capex that's driving that cycle, it's got to be all technology led and not the traditional build more transmission lines or power plants. That's not happening right now. So it's got to be capital-like businesses. It's got to be businesses that can build annuities from the grid or annuities from the customer. So that's that's a limited part of the market that we're trying to address out there. The traditional power plants do have an opportunity out there, but there is a very what should I say? There's a very finite valuation that you will pay for these companies on the ground because they are all very regulated in terms of their earnings. So right through the value chain, if you can build it, if you can put it together, pick the least capital intensive part of the market. Okay. Uh, Pick the most technology driven part of the market, and somewhere in the middle, you could also allocate money into the utility space and into the power producers there.
Right. So, how long is this profit upcycle going to be, Kenneth, according to you? If you're right that we are sitting at the cusp of a profit upcycle, though the horses will change, different companies and sectors will contribute the profits. But do you think we are in for a 4-5 year kind of a expansion in profit cycle? Because the last 10 years have been lean from a profit to GDP point of view.
My sense is it could last a decade. You might go into an overvaluation cycle in the next couple of years, but I don't think the profitability will come under a significant amount of pressure.
All right. Kenneth, in terms of realistic expectations now from the market, and this is a question we keep bouncing around, but for the retail or the slightly newer investor that's now enthralled with equities, how would you temper the expectations as to what to anticipate now? We're heading into 2022 in no time. What should they anticipate now that the worst of the pandemic is behind us? We seem to be on track for earnings growth. What's next?
I think you have to moderate your expectation levels, because I don't think there's any instrument on the ground that can give you a 15% compounded in perpetuity without any risk to it all. And I've seen probably the worst in 2018 and 19, where the indices were positive and we were negative. But you come through that cycle. I think all you need is patience and it will pull through. But always remember, buy a solvent asset, okay, buy a business that you know, and use some and from our perspective, use some very traditional ways of actually valuing that business. Of course, there is a lot of incentive on the ground right now, because a lot of investment banking or a lot of investment banking mandates exist, and there are a lot of new age businesses that seem hyper scalable. I'll just temper my expectations on that part of the market, that is not profitable. I mean, I haven't seen. This is probably the first decade that we've seen businesses which are loss making and trading at these valuations. I've never seen this before. So I just temper my expectations about some parts of the market. The rest of the market seems fairly okay.
Right. So let me ask you something about something which is not very export focused, but very domestic, which is the old age business of fertilizers, agrochemicals, even food commodities like sugar. Do you look at those baskets at all? Do you think there could be an opportunity there?
You are heading for an inflation in food prices and commodities, in agricultural commodities, and not for anything else. Is that you are linking the food basket with the fuel basket. So the more amount of biodiesel that our neighboring countries generate, okay, and at the cost of edible oils, and the more amount of ethanol we generate at the cost of it started with sugar, it's gone to grain, and now it's going into corn. Food inflation is going to be a reality for a better part of this decade. It's also an industry that hasn't been invested into for at least the last 20-30 years. US is the largest exporter of agricultural products. 2/3 of their country is in drought, and there are no irrigation systems that is countering this process. So I go back to the same thing. It's an industry, it's a segment and a sector of the marketplace which has not been invested in. Food has been food products are now entering the fuel chain, and up into 2024-25, you have a number of uh, ethanol plants coming out of corn. Okay, first you only had it out of sugar, so that's going to create inflation right across the board. There is an opportunity out there also. I mean, we've got, we've got the whole value chain which is listed right from agricultural inputs right up to food processors, except for agricultural land, which is theoretically not listed, but you could participate right across that food chain.
Kenneth, always a pleasure hearing your thoughts. Thank you very much for taking time out for us today.
Super. Thank you. Thank you, Udayan. Thank you, Abha.
Great. That's all from Abha and I for this week. We shall be back next Monday once again with another Market Guru. Till then,